Last week, we discussed Domino's Pizza, a discretionary business demonstrating strong resiliency in a frankly lackluster economy. This week, we are discussing a business that is quite discretionary on the surface, but is very sticky and nearly impossible for users to give up. In fact, I believe it is right up there with the iPhone in terms of how people view it as a part of their daily lives. Netflix headlines a busy earnings week as this season starts in earnest. Welcome to The Quality Investor. The last time I discussed Netflix, I laid out my premise as to why they are the king of streaming and only getting stronger. To summarize, I showed that Netflix is much more profitable on a per subscriber basis than their rivals. Watch that video for a breakdown of the math, but Netflix earns roughly $154 in gross profit per subscriber. That is annual revenue per subscriber less per subscriber content spend. Netflix's massive subscriber base and their ability to license and produce content much more cost efficiently than their competitors gives them incredible operating leverage. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Netflix is having a good 2025 year to date, up almost 40% before this latest earnings. Yet most of that gain came before June 30th. Since that time, the stock has slowly declined about 7.5%. The basic narrative about this decline is social media backlash around some new content and how this has caused subscriber loss. But I view this as an extremely isolated and frankly marginal event. In the long term for Netflix, it will be as if this never happened. I won't get into the controversy around it except to say that what doesn't get watch time on Netflix doesn't get renewed. Like YouTube, their algorithm rewards watch time. However, aside from Netflix's insane operating leverage, they have a newish revenue stream with their ad tier subscription. It began in 2022, and with about 94 million subscribers, up from 40 million in 2024, the revenue from the ad tier is expected to double in 2025 to around 2.5 to 3 billion. This equates to just under 10% of total revenue, so it is still a small part of the business. But Netflix is rolling out a new in-house ad stack in 2025, which will have features like pause ads similar to Prime Video and AI-powered interactive ads expected in 2026. Couple that with Netflix's concerted strategy of acquiring rights to live sporting events, an effort to make their content more attractive to advertisers, and Netflix is generating new ways to create value for investors. This will diversify their revenue model, and projections are that Netflix will earn $10 billion annually by 2029 from ads. For context, that would be 10x from their 2024 ad tier revenue. So, with many positive tailwinds for Netflix, there was a bit of a surprise in Netflix's earnings. The general belief was that Netflix would yet again beat Wall Street estimates and continue its march upwards. But Brazil had a different idea. The country slapped a tax on Netflix of $619 million. That tax alone represents a reduction of 5.4% in their operating margin, and without it, Netflix would have easily beat their estimates and even expanded their operating margin. This tax was a Brazilian national tax on outbound payments called the Contribution for Intervention in Economic Domain. It's a levy on outbound remittances to non-residents, typically at 10% on payments for royalties, technical assistance, administrative services, and technology transfers. A 2025 Brazilian Supreme Court ruling confirmed its broad application to various cross-border payments, even without direct technology transfer. To me, this sounds a bit like extortion, but here is what the more diplomatic Netflix CFO Spencer Newman had to say about it. So from Deadline here, we have this inside the surprise Brazilian tax that rattled Netflix's earnings. And we see here, it was unusual, asked on the post-earnings Q&A webcast, CFO Spencer Newman stressed two really important takeaways. And he said the first is that no other tax looks or behaves like this in any other major country in which we operate. And secondly, absent this expense, we would have exceeded our Q3 2025 operating income and operating margin forecast. And we don't expect this matter to have a material impact on our results going forward. And that's a key point. It's a one-off. So we really should not factor this in going forward in any of our Netflix projections. But in explaining what this tax actually is, he said it's a bit complicated. It's a cost of doing business in Brazil. It involves a 10% tax on certain payments made by Brazilian entities to companies outside of Brazil. It's not a tax that's specific to Netflix. It's not even specific to streaming. So we assume other companies will be impacted by this. In our case, Netflix Brazil pays Netflix US for services that enable Netflix Brazil to offer subscriptions to our Brazilian customers. And we actually received a favorable ruling from a lower court back in 2022 that concluded we were not subject to this tax, which is why we believe we could not accrue this. Now, they did flag this in several SEC filings as it relates to the scope of transactions covered by the tax and whether it applies to service payments that don't involve a transfer of technology. However, in August of this year, the Brazil Supreme Court decided against an unrelated company, ruling that the tax applies to a wider range of transactions than we thought was legally permissible, including service payments that don't involve a transfer of technology. So given that court's ruling, that's caused us to reevaluate the likelihood of prevailing, and we now deem the loss to be probable, and that's why we recorded the expense in Q3. And that's important to note, they accrued the expense. It looks like they put that into their accrued expenses on their balance sheet, and you can kind of see that reflected in the cash flow statement as well, meaning they added back that expense into the cash flow. So we should see a cash outlay for that either next quarter or in the Q1 of 2026. Now, this little hiccup caused a typical Wall Street overreaction. The stock is down about 7% post-earnings, even after the CFO stressed this has zero material impact on the results going forward. So let's dive into their earnings report and assess how they have been executing, especially on their ad growth. And as always, we'll review their valuation and determine if Netflix is at a reasonable price today to add this great business to your portfolio. Prior to the earnings, Netflix closed at $1,241.35, and you can see right after the earnings report, there was a stark drop-off in their share price, and they're down about 7% pre-market. We'll get into the details of the earnings here in a second, but I think there's really two reasons why we've seen that stark drop for Netflix. Aside from the Brazilian tax that I already mentioned, the revenue itself came pretty much in line with expectations. But there's also the guidance for Q4. So revenue guidance didn't change really all that much. However, they did guide to a slightly lower operating margin for Q4 than what they were expecting, as well as what Wall Street was expecting. So I think that also is hurting the stock a little bit. So we could see this 7% pre-market drop continue throughout the day. And that might be a good buying opportunity. We'll see here about that in a second. They are expecting an operating margin in Q4 of about 23.9%. And now that is lower than the other 3 quarters this year. But however, operating margins are historically lower in December for Netflix. And that's really due to the seasonal patterns with the holiday season, and Netflix tends to backload their content releases into this quarter, as well as higher marketing costs for the holiday season. In reviewing Netflix's earnings, my takeaway from it was they had a very good quarter outside of this whole tax debacle. You can see Q3, they grew revenue by 17.2% year over year. They're forecasting Q4 revenue growth of 16.7%. And from Q1 to Q2 to Q3, we could see revenue acceleration here. So they're doing a great job of growing the revenue. And like the CFO pointed out, their operating income would have beat their estimates had that tax not occurred. So yeah, their operating margin's down a little bit, but this is a one-time thing. And like we already said, that operating margin here in Q4 is a reflection of their seasonality. They're forecasting at 23.9%. It was 22.2% in Q4 of 2024. So that would actually be margin expansion there of 170 bips. Netflix is executing very well. And a huge part of that is just because they have massive operating leverage. Their content spend remains relatively flat. It grows a little bit year over year, but not as fast as what their subscriber base grows at. So because of that, they become marginally more profitable with each new subscriber. And yet, despite this tax, lowering their net income by $619 million. They still grew their earnings per share to $5.87, up from $5.40 1 year ago. And here's another interesting thing about Netflix. As I've documented on this channel with YouTube, the share of streaming is consistently growing in the United States. Linear cable is slowly dying out in the US. It's going to take a few more years, maybe a little over a decade, for linear cable to get surpassed by streaming. But if you look at the blue here, streaming back in Q4 of 2022 was at 24.8% of share of TV time. Now that's at 37.7%, and Netflix's own share at 7.5% in Q4 2022 is now at 8.6%. And streaming is slowly becoming the go-to option for people in the United States. And I said I wanted to look at how they're doing on the ads tier part of their business. So in less than 3 years, they've gone from 0 members on our ads plan to achieving sufficient scale in all 12 of our ads markets. And that's given them a very solid foundation, and they're increasingly confident in the outlook for the ads business. They're on track now to more than double their ad revenue in 2025. And because of that, their ad suite is now fully deployed across all of their ad markets, that in-house ad stack I was talking about. They're now have greater opportunities for innovation, like enhanced targeting and integrating additional demand sources. So the ads business is going well. It seems like they're on track or even beating their own expectations for what their revenues are going to be. And this might become a meaningful part of their revenue over the next 5 to 10 years. I'm not going to get too much into the numbers here. I already discussed that a little bit at the beginning of this segment. But we can see that the revenues year to date, $33.1 billion, a massive increase year to date so far from $28.7 billion a year ago. That's 15.2% year over year growth on a year to date basis. And that's why they're gaining market share. They're just better than their rivals. I do want to point out their free cash flow. So again, we had strong net income for this quarter, $2.546 billion. And that worked out to $2.8 billion in net cash provided by operating activities. Like I said before, we're not going to see that hit for that tax and probably until next quarter or the quarter after. And you can see that huge jump in accrued expenses and other liabilities, up to $707 million added back to the net income. And last quarter it was down, meaning they paid their accrued expenses. So this jump certainly looks like where they put that tax. So yeah, we're going to see a cash flow hit probably next quarter. But again, I want to stress that's going to be a one-time thing. Despite that, like I said, $2.8 billion in net cash by operating activities, but they only had $164 million in CapEx spend. Very capital light business. All their real spend is in content licensing, which is treated differently here. So they had a free cash flow of $2.6 billion in this quarter. That's free cash flow growth of 21% year over year. I mean, this is a business that's executing on all levels. So honestly, I'm happy to see that they're falling in the market today. The market's just opened as of this recording, and they're down over 8%. So hopefully they sustain these losses throughout the day, because I would love to buy some Netflix. And on that note, these are my projections on a 10-year basis for Netflix. See the streaming revenue here. I have it at 10.3% on the bear case, going up to 15.6% on the bull. I'm trying to be a little conservative on the bull case, considering we don't know yet how much the ad revenue is really going to affect them on a longer-term basis here. But this growth here pretty much means they're in line with what their 5-year historical CAGR is. I do think Netflix is still a growing business, so they could easily match, maybe even exceed their 5-year CAGR. Operating margin, I have that growing to 35% on the bear case, up to 45% on the bull case. Again, trying to account for that massive operating leverage that Netflix has. And if we come down to the free cash flow margin, on a trailing 12 basis, their free cash flow margin sits at 20.7%. I have that growing to 27% on the bear case and up to 44.9% on the bull case. Like I showed you before, this is a very capital light business. And as they continue to scale, they're just going to become more and more profitable. Netflix has a lot of upside in my view. I think they had a massive run up in 2025, and that made it a little unattractive. But before I show you what price I think is a good one, note the free cash flow growth on the bear case here is 16.2% annually on a 10-year basis. 21.4% on the base case and 27.3% on the bull case. As of this recording, Netflix is trading at $1,144.76. So they're down almost 8% on the day. They have a PE ratio of 47.8 and a forward PE of 45.3. Now the PE ratio is a little bit cheaper now than their 5 and 10-year average. And the forward PE sits pretty much right between their 5 and 10-year average. Using this current share price, and we do a reverse DCF, the market is now projecting free cash flow growth over the next 10 years of about 15.8% for Netflix. My own base case has them at 21.4%. So obviously I'm a little bit more optimistic. But again, remember, they just dropped their share price by about $100 so far on the day. Looking at the bear case DCF, it's at $923.18. Base case is at $1,368.15, and the bull comes in at $2,126.82. So you can see if they execute, and especially execute on the ad tier, there's a lot of upside for Netflix. That gives us a buy price without any margin of safety of $1,446.58. But I like a 20% margin of safety for Netflix. I think they have to execute for a few more years before I'm willing to put them into that 10% margin of safety category as a very safe, reliable business. But given that, that's a forward PE of 45.8. And based on today's drop, they're now a buy at that 20% margin of safety. If you're a little bit more risk averse and want to see them come down more, at a 30% margin of safety, they're at just over $1,000 at $1,012.60. To be honest, I think I'd be comfortable adding Netflix at this point, but would also like to see it come down a little bit more, maybe under $1,100. I do believe there's a lot of room to grow for Netflix going forward. In fact, news dropped yesterday that they're preparing a bid for Warner Brothers Discovery. Now, when you look at that bid, it's important to note they only want the content and streaming side of that business. They do not want the cable and news side of that business. The streaming side includes all of Warner Brothers' content history, plus the HBO Max. That would be a huge boon to Netflix's subscription, getting all that HBO content onto Netflix. But if they acquire the Warner Brothers news and cable side of the business, I think that would be what Peter Lynch calls a diversification. I don't think that would be a good business for Netflix to get into. So it's going to be interesting to see how that plays out. It's very speculative right now, and any movement on that, there's a lot of other businesses out there making bids for Warner Brothers, won't happen until 2026. So that remains to be seen. I'll link some articles to that in the description though. All in all, I think Netflix is a very bright future. Let's hope they make smart acquisitions. Hint, hint, Warner Brothers. And like I said before, their massive operating leverage is just going to increase their profitability and ultimately their free cash flow available to investors over time. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.